Welcome to Manager EDU. Today, I will teach you a very important topic in finance, beta. Beta measures volatility or systematic risk, a stock's volatility relative to the overall market. In this lecture, I will cover beta professionally. I will teach the formula, split the formula into detailed parts, tabularize the data, and then show you data graphs so you understand it better. So, let's get started. Beta is a financial metric that measures the volatility or systematic risk of an individual security or portfolio compared to the broader market. Let's understand its concept with an example. We have a stock market like the S&P 500. About 500 companies are listed like Tesla, IBM, Microsoft, Alphabet, Nvidia, Amazon, Apple, Meta, and many others. When we analyze a stock market, the graph moves up and down in different time periods. Its movement depends upon all stocks. When we check an individual stock, like Tesla, we ask, does the market impact the individual stock? Does it have a correlation? Beta calculates how the market and the individual stock move together, whether they move in the same direction or differently. In other words, does the market affect the stock or not? In this example, the overall market is the S&P 500 and the individual stock is Tesla. From this graph, we can see that Tesla's stock is more volatile than the whole market. But how much more volatile? That can be calculated with beta. The formula for beta is beta equals covariance of RS and RM divided by variance of RM, where covariance of RS and RM is covariance between stock returns RS and market returns RM. Variance of RM is variance of market returns. And RS stands for return from the stock, RM stands for return from the market. To calculate beta, we will deep dive into everything. First, we must understand return because it will come up again and again. So, the difference in stock price between two time periods is called return. From any stock market, we can collect stock prices. For example, I've taken Tesla's monthly opening and closing prices. January, opening $95, closing $100. February, opening $100, closing of January, closing $107. March, opening $107, closing of February, closing $102. And we collect all the data for 1 year from January to December. To calculate the return, we deduct the opening value from the closing value. January, 100 minus 95 equals 5. February, 107 minus 100 equals 7. March, 102 minus 107 equals negative 5. And so on for each month. If you want to calculate the percentage change, divide the return by the opening value and multiply by 100. January, 5 divided by 95 multiplied by 100 equals 5.26%. February, 7 divided by 100 multiplied by 100 equals 7%. March, negative 5 divided by 107 multiplied by 100 equals negative 4.67%. And so on for each month. You can calculate beta using either the raw return values or the percentages. To practice, you should try both. These were the returns from Tesla stock. Same returns can be calculated from the S&P 500 also. Now, as you know the formula, first we will calculate the variance of market returns. The formula for variance of market returns is variance equals summation of open bracket x minus mean close bracket squared divided by n. Here, x represents the S&P 500 returns. We need this data. Let's create a table for the S&P 500 monthly returns. January, 5. February, 5. March, negative 3. And so on for all 12 months. N equals the number of returns, which is 12. First, calculate the mean. Sum of all S&P 500 returns equals 30, so mean equals 30 divided by 12, which equals 2.5. Next, calculate X minus mean for each month. January, 5 minus 2.5 equals 2.5. February, 5 minus 2.5 equals 2.5. March, negative 3 minus 2.5 equals negative 5.5. And so on for each month. Then square each of these. January, 2.5 squared equals 6.25. February, 2.5 squared equals 6.25. March, negative 5.5 squared equals 30.25. We calculate this for all 12 months. Then we sum all the squared differences. The total sum is 279. Now, variance equals 279 divided by 12, which by calculating it, we get answer, which equals 23.25. Congratulations, we have successfully calculated variance, 23.25. Now, let's understand what this value means. Variance tells us how spread out these returns are from the average. The mean of S&P 500 returns is 2.5. That is the average, shown as a green line. The variance measures the distance between the average return and the actual returns, shown as red lines. The square root of variance is the standard deviation. In this case, the standard deviation is approximately 4.82. This means the stock price is expected to go up or down by about 4.82 on average. Technically, we can say it is the average size of the S&P 500's monthly misses. First answer of variance, which equals 23.25. Now we move to beta's second part, covariance of stock return and market return. The formula for covariance is covariance equals summation of open bracket x minus x bar, close bracket, multiplied by open bracket y minus y bar, close bracket, divided by n. Here, X is the S&P 500 returns, and Y is Tesla's return. Let's create a table for the whole year. January, S&P return equals 5, Tesla return equals 5. February, S&P return equals 5, Tesla return equals 7. March, S&P return equals negative 3, Tesla return equals negative 5. And so on for all 12 months. N equals 12. First, calculate X bar, average of S&P 500 returns. Sum of S&P 500 returns equals 30, so X bar equals 30 divided by 12, which equals 2.5. Next, calculate Y bar, average of Tesla's returns. Sum of Tesla's returns equals 42, so Y bar equals 42 divided by 12, which equals 3.5. Now, calculate X minus X bar for each month. January, 5 minus 2.5 equals 2.5. February, 5 minus 2.5 equals 2.5. March, negative 3 minus 2.5 equals negative 5.5. And so on for each month. Calculate Y minus Y bar for each month. January, 5 minus 3.5 equals 1.5. February, 7 minus 3.5 equals 3.5. March, negative 5 minus 3.5 equals negative 8.5. And so on for each month. Then multiply each pair. January, 2.5 multiplied by 1.5 equals 3.75. February, 2.5 multiplied by 3.5 equals 8.75. March, negative 5.5 multiplied by negative 8.5 equals 46.75. We calculate this for all 12 months. Then we sum all the products. The total sum is 370. Now, covariance equals 370 divided by 12, which by calculating it, we get answer, which equals 30.83. Before calculating beta, let's understand what covariance means. Covariance tells us how two sets of numbers change together. In the first graph of the S&P 500, you can see how it moves. In the second graph of Tesla, you can see how it moves. If we draw a regression line on S&P 500, it moves from left to right upward. If we draw a regression line on Tesla, it moves from left to right upward. This means they have a positive correlation. In our example, the covariance is 30.83, which is positive. If the covariance were negative, it would mean they have a negative correlation. Now we have both parts of beta's formula. Covariance equals 30.83 and variance equals 23.25. Beta equals 30.83 divided by 23.25 equals 1.33. Congratulations, we have successfully calculated beta, 1.33. Now, let's understand what this value means. A beta of 1.33 means that Tesla's stock is more volatile than the S&P 500. When we combine both graphs, you can see that the Tesla line moves faster and has more variation than the S&P 500 line. Now, how should you make decisions by looking at beta? Let's understand different beta values. If beta equals 1.0, the stock moves exactly with the market. The graphs of the S&P 500 and the stock show the same behavior. If beta is less than 1, the stock is less volatile than the market. The market graph moves more up and down, but the stock moves more smoothly. If beta is greater than 1, the stock is more volatile than the market. In our example, beta is 1.33, so the market moves smoothly while the stock moves more variably. If beta is less than 0, the stock moves in the opposite direction of the market. As you can see in the graph, when the market moves from left to right upward, the stock moves left to right downward. This means the stock is against the market. I hope you understand all of this conceptually. Beta is one of the most powerful tools used in portfolio management across different markets such as crypto, stock markets, currency exchange markets, and many other trading markets. I have tried to teach you beta in a simple and conceptual way. I hope you liked this method. If you have any questions, please ask me in the comments below. Like and subscribe to my channel. Thanks for watching.